Hello and welcome to the latest Insider interview. Our guest today is Ben Rogoff, who is the manager of the Polar Capital Technology Trust. Ben, it's great to have you in the studio.
Thanks for having me.
The Magnificent Seven is the big theme in tech investing, but where do you stand on these giant American technology shares?
Well, I mean, about a third of the portfolio is still invested in the Mag 7. And, again, you only have to get a few things right in life and investing, as someone much smarter than me once said. And I think, we made a very key decision, probably nearly 20 years ago, to move away from a multi-cap investment approach to really looking more at the index. Now, again, that's very uncool to talk to index, but actually the index has been a phenomenal thing to be tethered to for most of the last, ever since really the great financial crisis. And one of the reasons for that within tech has been that really the larger got larger. We've seen this, the Mag 7 are really a manifestation of the fact that some very large companies have ended up dominating the profit pools associated with technology, be it Microsoft in software or obviously Google in search and so on. And so we've been delighted with the Mag 7 exposure that we've had, and it's probably been higher than most. So how do we feel about it today? I think the answer is it's more nuanced. And by the way, that's a sort of you've got to be slightly careful what you wish for. These companies have been the engine room of PCT's performance, haven't they, over a sustained period of time? But they've also been very difficult to outperform. So, again, we'd love to see the market broaden, just like others. You, in the end, though, have to operate with the market that you've got and not the one that you want. So, but why? What are we doing at the margin? The answer is we're reducing Mag 7. We're doing that not because really anything has gone wrong with those businesses, and in fact, we've got lots of Nvidia at 12% of the portfolio, and we're still, overweight Amazon relative to an index that, albeit, is at zero. But we feel that they've been incredible conduits for AI for the last 2 years. But we're beginning to feel that some of them are looking less good conduits for AI over the next few years. And so we've reduced our Alphabet Google exposure, where they've got obviously an incredible model. They've got a cloud business that's on fire. They've got Waymo. There's lots of great things about this company. We've owned it continuously since it came public. So we're huge fans. But they also have lots to lose from a world where 800 million people are now using OpenAI's ChatGPT. So that one we've been reducing. Apple also, I've owned it continuously since 2003. It's probably the best investment decision I ever made. Everything I've done subsequently with that stock has been wrong because I bought 1% of the trust in 2003 and I should have just left it there. But joking aside, one of the most phenomenal businesses on earth. But smartphone penetration has been full for a sustained period of time. The company, is not struggling, but certainly replacement cycles have extended. The hope is that AI will revitalize iPhone sales, and they try to launch Apple Intelligence as a way to do that. Our sense is that Apple Intelligence hasn't been great, but more importantly, we feel that AI is something you're going to do in the largest model, the most complex, sophisticated. It's sort of not maybe a winner takes all, but a winner takes most, which is why, of course, the OpenAIs and others are spending so aggressively to have the very best model. Apple doesn't have a model. And so, in a sense, is a bit of a spectator to what happens next. And that's given us a good opportunity to reduce our exposure there. So at the margin, we expect to keep reducing the Mag 7 names. I think we can find better conduits for AI elsewhere.
Just how expensive are technology stocks? It's often a very pricey sector, but where are we now versus history?
Well, look, markets are at the higher end of where they've tended to trade. That's not just true for tech or even for the US, but it's true to say that things are not cheap. But I think the forward PE of the US tech sector is in the high 20s, which is a level that I think some people will find uncomfortable. The relative PE, so when you think about what PE do you pay relative to the PE for the broader market, is around 1.4 times the market multiple. And I think, again, going back to a post-great financial crisis range, that is towards the high end of life. Having said that, we're 3 years into a new AI cycle, and there are some incredible opportunities for technology to redistribute profit pools, both within the tech sector, but also beyond it. And, the earnings profile of our portfolio is very much at the higher end of life. We're hopeful that our portfolio can grow earnings, 20% plus. We're still trying to build a portfolio that's diversified because there will be challenges and along the way to some of those companies. But the profile of tech is strong. It's meaningfully better than obviously the broader market. And let's not forget that, at least in our view, we're going to see more AI disruption. We're going to see companies that fall foul of AI as some of their core propositions are challenged by ever better models. If that's true, the premium that you pay for a tech company that's delivering that disruption, I think all things being equal should be relatively high. One last thing, if I may. I think the conversation about valuations is obviously relevant, but I think that often people bring it up as a way to sort of, I suppose, denigrate the technology story. And I think, of course, everybody wears, we're all sum total of our cumulative experience. And for people that are around in the 90s, like myself, the dot-com period was, a tricky one. Obviously very exciting on the way up, and then learned an awful lot on the way down. And I think that people want to liken the current period to that that 90s experience. But if one does, then you sort of come away sort of empty-handed, because here we are today trading on 29 times and 1.4 times. So yes, at the high end of life, but in the late 90s, when people were super excited about .com, and it was at the heady end of that, the tech sector traded in the 50s and 60s on a forward PE, and we traded on more than 2 times the market multiple. So look, things may be a bit extended, but I think with good reason, and we look nothing like we did at the end of the late 90s.
Volatility is another big theme with technology shares. Your trust, has been known to fall 20, 30% in value over certain periods. So how do you manage that as an active portfolio manager?
I mean, I want to say that there aren't that many drawdowns of that magnitude, but there were plenty of double-digit setbacks. And obviously this year we had the DeepSeek moment in January where, I think for a brief, not that brief, but for a window at least, there were some question marks around the sustainability of AI capex, cheap Chinese model. Why would anybody build another AI cluster again? And thankfully, that's just not been borne out at all. We've seen all of the hyperscalers raise their capex through the year, and now again, that's sort of almost a contained episode, but it didn't stop stocks falling very hard. So I think what I would like to say, if I may, is that firstly, and I can't give investment advice, obviously, but I think the most important takeaway from the volatility that is inherent with technology investing, but also any single sector investing, is to have an appropriate amount of risk, but also to have the right investment time frame. If you have the right investment time frame, and I've been a PCT holder since the day I joined Polar in 2003, again you can ride the volatility, those setbacks better if you've got the right investment time frame. But it is worth pointing out that DeepSeek episode is unlikely to be the last time that the AI story is challenged. We're 3 years into a new cycle. We're all still learning on the job. And that Chinese model introduced some innovations around how you build a large language model that were new news to almost everybody. Maybe not to Jensen Huang at NVIDIA, but to nearly everybody else. They were pretty scary, and the headline sticker shock of being able to build a model for $6 billion when everybody else is spending billions was pretty uncomfortable. And of course, it turned out that those numbers weren't quite right. The point really I'm trying to make is that when you're really in this steep part of an innovation curve, and where investor understanding is still quite limited, you're going to get setbacks. And I just think, 95 to 98, which feels to us broadly analogous with where we are today, which, by the way, was a really good period for markets. And again, history is only an imperfect guide, of course. Actually, we had 7 setbacks of 15% plus in the NASDAQ 100 during that time. So I think it's not a question of buckling up. It's just a question of expecting volatility. It's inherent to new technology cycles.
And with the investment trusts, it can be even more volatile because of the premium and discount mechanism. What is the discount on the trust at the moment, and do you see that narrowing?
Well, the discount is sadly become a feature of investment trust, it seems, and an industry-wide challenge. I think that discounts have sort of stayed stubbornly high. I mean, I think ours today is more like 8, 9, but nonetheless, we're not comfortable with that number. And again, this is an incredibly liquid portfolio. We're delighted with the return profile it's delivered. I think it's a very well-loved trust. Probably not for me to say, it's probably for others to say, but we're a FTSE 100 and we've got a long track record. And I am hopeful actually that discounts can close. The company continues to buy back stock. It's a very creative thing to do. It's great for long-term holders because you pick up the accretion associated with buying something that's trading at 90p in the pound. And I think if we can continue to deliver good numbers, if we can do what it says on the tin, if we can do that in a way that's cost effective, I think this is a very competitively priced trust, in my opinion, and I think we removed our performance fee not long ago, and I think that if we can deliver, if AI can deliver, if the portfolio stays liquid, and if people begin to really embrace the tech sector, that there's no reason why this discount can't close.
One of the best ways to own tech shares over the past 10, 20 years has been to own an index fund tracking the NASDAQ or a global technology index. So why should investors pay up for an active manager like yourself?
Well, it's a fair question. I mean, look, I think PCT has been one of the very best ways to access the tech sector over a sustained period of time. I'm kind of almost reticent to talk to the long-term annual return profile, because I don't want people to think that necessarily is something that we can sustain. But they've been, phenomenal returns. But you're right in that, particularly during the last few years where things have become very narrow, it's been difficult for active managers, ourselves included. And, if you look at, say, small cap, large cap, just over that 2-year time frame that I haven't been here, I think small caps are up 20 and large caps are up 70. That's a pretty formidable headwind for, active managers looking for slightly off the beaten, track ideas. So how do I feel about it today? I feel pretty good that active management is not, again, I'm sure that everyone that comes on to talk to you will tell you that, today's a great time for active managers, and, but I do genuinely feel that, and you can see that we're now meaningfully ahead of the index over 1 year and 2 years. We're back in line with the index over 3 years, and that's of course after costs. So that reflects a portfolio where active share is already now into the high 40s. So this is a portfolio where we build the book or the trust around the index, but we're unafraid to take very big negative bets. And so we have a very small position in Apple relative to an index. We have a very small position, or relatively small position in Google today relative to the index, and so active share is already into the high 40s. But more importantly, if Mag 7 becomes a slightly less good conduit for AI, and I think there's an interesting two-way debate now that's a sort of becoming more established. If AI becomes much more disruptive, which we believe very strongly that it will, then indices that are market cap weighted are of course dominated by companies that have done well, not necessarily companies that are going to do well. And so I think that's a really interesting setup for us as an active manager, that we could take some really big negative bets where we feel appropriate. And again, move carefully, because I'm doing this a long time, and we tend to, I think you have to move carefully, because Mag 7 are phenomenal businesses. These are not, they deserve to be where they are. But one last point, if I may, which is to say that that the technology universe is in flux, and where value is being added is changing, and ETFs aren't going to help you with that. They're not going to help you identify companies at the margin of technology where they may be embracing AI that allows them to, capture a profit pool that didn't exist before. Take a company like Axon, which has become a very popular name. We've owned that stock in the trust for nearly, I think, more than 10 years. Axon, for those that don't know, makes the body cams, the taser, non-lethal weapons, but also body cams, and now software that allows really modern policing, modern law enforcement. And that's been an absolute humdinger for us, candidly. That company's not in a tech index. Now, if we're right, we're going to find more Axons. We're going to find companies that are at the periphery of tech that will get dragged into the technology story as AI proliferates. And I just think the combination of a market cap, cloud, smartphone heavy index and the opportunity set that comes from AI disruptions just set us up very well.
And finally, the question we ask all of our guests: do you personally invest in your fund?
It's a good question. It's a very fair one, and the answer is unequivocally yes. I in fact bought shares in the trust on the very day that I joined Polar. I've held them ever since. I've taken some away over time. In fact, I actually bought some not that long ago. So I am a holder of PCT, but more than that, I've been at Polar for a very long time. PCT is synonymous with the business that I've been at now for more than 20 years. We love everything about this trust. The same is true for my deputy, Ali Unwin. I know he owns the PCT too. We live and breathe this trust. So yes, of course, I'm an investor in it. I'm excited about the medium-term prospects for returns, but also I obviously have to have skin in the game in something that I believe in, but also something that we've got lots of external investors into.
Ben, thank you very much for coming into the studio.
Thank you.
And that's all we've got time for today. You can watch more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.